solid. Okay, so let's start like the smaller time frame. This is a question that I've seen in the chat multiple times already, so hopefully after this blog it will be clarified for everyone. In terms of entries, okay, I'm gonna be drawing right here. Okay, let's say this is a very scenario. Okay, let's say this is a H1 time frame. Okay, the black one. So let's say we have our IFC candle right there. Okay, when I say IFC candle, we also name it as, let's put it in red. Okay, it can also be, let me draw it right here. Okay, IFC, in this case, supply zone or point of interest. Okay, so you guys will see in different times calling it like this. Why is the reason of this? At the end of the way, an H1 candle can be, let's say this is 50 pips, a 50 pips range between the open and the close of the candle. Okay, so of course we are not going to be trading with a stop loss that big. Maybe for the people that are starting, maybe it's better to start in these time frames, then walk yourself to a lower time frame gradually, not first of all. But we know that now we have a lot of people that are more experienced in this mentorship. So for the purpose of that, we're going to be looking for 4 types of scenarios while the price is getting back there. Okay, so once we reach the point of interest, okay, as someone mentioned, you can have, let's say, 1 point of interest right there. Let's say this is a 1 minute imbalance. Okay, and then you can have, okay, let me change the color for a second. Okay, I'm gonna put in blue. Okay, so blue lines are gonna be small point of interest, one being a little bit higher, the other one being a little bit lower. Okay, inside my H1 candle. Okay, let's say blue is M1. Okay, when I mean M1 is small imbalances inside our IFC candle of H1. Okay, so this is something that we have created ourselves, that through backtesting, through going through a natural fractal of the market, we came across it. So if you guys want to take note, there are 4 scenarios that we're going to be looking at. The first one, okay, is going to be the price will walk up until it reaches our point of interest. Let's say it's this one. Okay, so then we'll draw a momentum trend line. Okay, once the price reaches that momentum trend line, this is going to be the first pattern that we're going to be looking for, is equal highs, small FU candle with a break of a structure, and then we're going to be selling from our IFC candle right there. So we'll be selling from there. Okay, so this is going to be our first pattern in the smaller time frame. When I mean smaller time frame, is going to be between M1, M3, M5. Okay, so M5 and below. Okay, so this is going to be our first pattern. What this is allowing us is, let's say we have a 50 pip range in terms of our IFC, as I mentioned before. If we're playing this smaller time frame confirmation, what is making us is our entry will be based right there, and our stop loss is now going to be based on our IFC candle of the 1 minute time frame. Okay, right now I'm drawing it right here, but I will show you guys examples in a bit. Okay, so this is going to be our first example. Okay, simple, equal highs, FU candle, break of a structure, retest on our IFC candle. Okay, important thing, whatever we have taught you and Wakar in the smart money section about smart money, equal highs, equal lows, liquidity, is the same type of stuff, or even myself with the structure the first day, is the same stuff that we're going to be applying in the 1 minute. Okay, so it's literally the same. Okay, so this is going to be the first scenario. Let me erase, and we go for the second one. Second one, the same. We see the price in a smaller time frame walking up to our point of interest. Okay, and now we're going to be classifying this as a momentum trend line and this is gonna be more a type of head and shoulders scenario. Okay, so our number 2 is gonna be head and shoulders type of a scenario, being again my IFC candle, this one, with my entry right there, and my stop loss just above the smaller time frame, head and shoulders, the IFC, that one. Okay, we don't. What this is allowing us technically is, again, instead of putting our stop loss, let's say up here, we are reducing our stop loss for maybe 2/3 just by this smaller time frame confirmation. Okay, so this is gonna be the second type. Let's go to the third one. Okay, the third one is gonna be, again, price goes up, we reach a point of interest, and then market starts to distribute. Okay, so we're gonna have one drive, two drives, our UTAD with our, again, IFC candle, our test, then come lower, entry here, stop loss up here. Okay, remember also, we are gonna consider also imbalances right there, okay, previously to our IFC candle. So the same way we look at it in H1, H4, we're gonna be looking at M1, M2, M5, those smaller time frame confirmation. Okay, of course, this is on a supply area. If we are looking up in a demand one, it's gonna be the contrary. So it's gonna be 3 drives to the downside, test, and going to the upside. Okay, so I'm just telling you guys in a bearish scenario, but the same on the contrary will apply in a bullish or in a demand area to be buying. Okay, that's gonna be the third one. And the fourth one is gonna be just, again, price goes to the upside with momentum, and then we have break of momentum trend line, our last higher low that creates my last higher high. We reach our point of interest. Okay, now I have a break of a structure right here, the retest on our IFC candle, entry right there, stop loss right there, allowing us to trade from there. Okay, so just to repeat again, first one is gonna be simple equal highs, break of a structure, take out liquidity, and we go to the downside. The second one is gonna be a head and shoulders pattern, being this equal lows IFC candle, taking it from there. The third one is gonna be a simple accumulation or distribution, 1, 2, 3 drives to the upside, and we sell it in the test after the UTAD or after the spring, being the contrary. And the fourth one is gonna be just a simple break of the structure. Okay, that's why it's so important to properly understand also market structure in the lower time frame, in the higher time frame, because this is what's gonna allow us to now properly understand in the smaller time frame. And you will see multiple examples right now where the complex pullback plays a big thing on a smaller time frame. So it's something that we really need to understand to play these high risk reward trades. Okay, so moving on. Okay, now we have this. Just to show you guys a couple of examples, this is gonna be all based on M1. Okay, this trade is a trade that I show you guys. Even let me go for a second right here in structure. Okay, because I remember we went through it. Okay, here. Okay, this is GBP USD. Probably you guys remember from the first day of a structure. This was my H4 impulse to the upside. Okay, this is H1 time frame. So we know H4 is bullish. Okay, now after this impulse to the downside, okay, market creates a new higher high, breaking a structure in H1. So now we have H4 plus H1 bullish, right? If we see again, this point here actually creates a new higher high. Okay, so this point right here, this point right here that you guys see is gonna be the one that we're gonna be zooming in on a smaller time frame. This is based on a point of interest on a demand zone based in a smaller time frame, like I think it was M15. So when we go to M1, where is a smaller time frame? Okay, this is the H1 demand structural point that I marked right there. So look how price acts. Okay, this is gonna be our fourth confirmation that I just spoke about. So the price will come to my demand zone. This is my last structural point. Let me take this out. This is gonna be my last structural point, lower high that creates my last lower low. Okay, think about something. When the market needs to reverse or needs to start or change from bearish to bullish or bullish to bearish, what is gonna be the first time frame that is gonna switch to then allow the market to go, let's say, from bearish to bullish? Okay, that time frame is gonna be maybe a 10-second, 15-second, 30-second, 1 minute. Okay, so 1 minute break of a structure is what is gonna lead to the M5 break of a structure, to the M15 one, to the H1, and that's how price moves to the upside. Okay, so after that break of a structure that I marked you guys right there, okay, after that we see price coming where? Exactly to our IFC candle in the 1 minute time frame. If you guys see, let me erase this for a second on this. Okay, if you guys see this small refinement entering in M1 is allowing you to reduce your stop loss, at least in this case, at least a third. Oh. At least all this area, okay? Which maybe doesn't look that much in this scenario, but it's gonna be a huge difference on your trading. And again, why it's so important to understand structural points? Because now we have a new point that creates a new higher high, okay? I'm just marking here London session because it's something that I personally have back tested in euro dollar, and that's why it's one of my favorite pairs. My main entries, this is not, I'm not saying that it's not gonna happen in other times of the day, but my main entries are gonna happen on London and New York. So that's also really important for me and Wakar and Wally. Why? Because think about the spread. So if I'm trading, this is a I think this was a 2 pip stop loss, in 3 pip stop loss, sorry. Okay, this was my actual 3 pip stop loss. This was my actual trade, this one. Okay, if I'm trading a 3 pip stop loss GBP USD, I need to have the lowest spread. And the reason is because if I'm not in the session from London, New York, which they have a low spread, and I have, let's say, another 3 pip stop loss, I'm literally doubling my stop loss. So I'm reducing by half my reward. So we don't want that. That's one important reason why we need to be trading also in these sessions. Also, something, okay, you guys see, this was, again, my entry based on that IFC candle. That was my stop loss. Okay, it was like 3 pip stop loss. Another thing that I like to look a lot in smaller time frames, so you guys can note it, is every time I see this momentum changing, okay, this is the fourth one that I just explained, a simple break of a structure when we reach a point of interest. I like a lot to have these imbalances in the smaller time frame up here. Okay, and the reason is because this is not going to be my target, because overall I'm trading in a H4, H1 time frame, and assuming that we're going to create a new higher high. This trade ended up being a 1 to 60. But what I like about this imbalance up here is that I actually know that if all the imbalance is already filled in this zone, lower zone here, and we have all this imbalance up here, I know the market most likely will come at least to these levels. Okay, I don't have a control of the market that the market then comes lower. Okay, but now I'm trading a probable scenario that when the market is at these levels up here, I know that with my entry right here, I'm gonna be break even, just a pip right there. So now I'm risk free, but now I have a high confidence trade that the market will come to at least to those levels, and most likely will go higher. Because the reason of this is because, as I showed you before, showing the M1, the scenario is that H4 and H1 was bullish. So what's gonna be the first time frame, again, I wanna repeat it, what's gonna be the first time frame that is gonna switch from bearish to bullish to support my H1 new higher high? That's gonna be M1. So if I'm able to catch the first movement, I'm gonna be literally in a safe spot in that sense, because now when the trade moves a little bit in my favor, let's say 20, 30 pips, if it does any sort of spikes right here, I'm in the low entry. So that's gonna give me some room to be safe in that sense, catching the lowest entry. Okay, so that's example of the fourth one. This is again another example. Now that you guys have seen the refinement, is gonna make a lot of sense. If you guys see right here, this will be our sell to buy candle, right? But actually, we have a lot of candles going to the upside in a smaller time frame. So my only 2 points of interest are gonna be this low one and this one. Okay, so now I have 2 points of interest. Instead of placing a limit, what I'm doing is wait for the reaction. So when I see this reaction in a smaller time frame, I think this was M3 actually. I see M3 lower high, lower low, broke to the upside. Now, when I zoom in, I see that my only, let's say, last IFC candle to mitigate is gonna be this one. Okay, so again, this ended up being like a 1 to 80 or 1 to 60, but I didn't, of course, in this one I didn't manage to get the full percentage. Another example, this is gonna be also in the smaller time frame, just so you guys see a little bit in these terms about structure. We're consecutively creating new lower highs and new lower lows, and then the price breaks. Look exactly where we come. Again, we have 2 points of interest, this lower one, but we have this one before. Okay, so after this reaction right here, if we didn't place a limit right there, look what the market did. We create a new higher high. Now look all the void that we have right there. We are not playing it from the sell to buy candle. We are playing it from this point right there. Okay, so now the market comes here, fills it in the, I think this is M1 or M2 in euro dollar. Another scenario, again, you see we have a point of interest right here with our IFC candle. Then we have our momentum trend line. The market is kind of respecting it. Here we break a structure for the first time, retest, we confirm a new lower low, but also we break the momentum trend line. The momentum trend line is, we focus it just for the sake of seeing how the market in a smaller time frame, when it reaches a point of interest or a supply area in this case, we see how the market moves from that point and starts switching the momentum in that sense, like as the proper word says. And look, where do we come? We come properly to that IFC candle. You guys can see, we don't look for the buy to sell in this case. We look for the black one, okay, right there. Where do we take our profits? In this case, it was a bullish market. So we are not going to be looking for just come to these lows, but maybe feel these sort of imbalances right there. Taps to the pip. Okay, moving on again. Okay, I remember exactly this trade. Wally bought Euro AUD, I think like a month ago. I don't remember exactly, like maybe 3 weeks ago. And I remember also for the person that was asking exactly how do we hedge. So for example, Wally, I remember was buying it from, let's say, something like this. So he bought it right here, okay? And then when you came a little bit higher, we had an IFC candle super clear in H4 right there. So when the market came here, something that you guys can do is, instead of closing these buys, okay, maybe even like just get the full volume, like don't even partial out. When the price comes here, you set an alarm and now you monitor price action. So what we were doing is, when we saw M1, how was acting in this H4 point of interest, IFC candle or supply zone, look how we come here and we are creating new higher highs, higher low, higher high, higher low, and higher high. Okay, right here in this point right here in the blue zone, the market didn't give me still a reason to enter, because yes, we are failing to create a new higher high, but we still in a complex pullback, and that's the reason why it's so important. So once the market fails, you guys see fails to create a new higher high, it breaks the structure right here. So I put it here with a red line. So we broke a structure right there. So the one that led to the break of a structure, I don't know if you guys can see really good, but look how accurate then the market when breaks a structure. Let me put it in green here. Okay, literally comes right there, perfectly respecting your stop loss. Okay, but again, that move created a new lower low. Okay, the push was pretty big, creating a new lower low, retraces a little bit, and then creates equal lows. Okay, again, let me now erase this point here. Okay, so now let's look right there. If we focus on the buy to sell candle, we're getting a huge candle, even it's in the 1 minute. But because now we have our refined candle, now we're gonna be focusing on this point right there with our stop loss right there. Okay, so when we move to the future, okay, respected perfectly. But another way to do is now you have a point of interest. Okay, so you watch the market, how it reacts right there. So now you have a momentum trend line. Okay, the price in a smaller time frame is perfectly bouncing off it. Okay, once we reach this point of interest, the market starts to fail to create new higher highs. And this point here breaks the momentum trend line, small retest, but then we have a break of a structure from this point to this point. So now we had our IFC candle right here that tapped it twice with our stop loss right here. Okay, this trade ended up being like a 1 to 40, and literally, I remember, literally was in like, I think it was the quicker 1 to 40 I've ever done, because this was literally in 25 minutes. But I didn't manage to get all my profit because I partial out and let the rest run, and then the market ended up continue going up. So this is another way that when you had bought here and you were, let's say, selling right here, okay, the market came to a structural point right here and then came to the upside. But now you managed to partial out here and maybe partial out here, or don't even partial out and hedge your buy with your sell. Now you are in a position that whatever the price goes upside or downside, you're going to be having a huge profit. Because, for example, if this one I didn't partial out, because if this one created new lows, this was another 1 to 100, but it didn't. Okay. Also, I don't know if I'm going, let me check the chat really quick. I don't know if I'm going really fast or people are able to properly understand everything. Let me check here. Okay. Everything good? Okay. Yeah, if I'm doing it too quickly, don't worry. I'm gonna be showing you guys a lot of examples, so you will click. Okay, so let's keep going. Okay, this is another example that I took. This was EuroCAD. Okay, daily I think it was bullish, but H1 H4 was bearish, and actually M15 is the red lines that I'm drawing right here. Okay, so I knew we were in a, even though daily was bullish, we were in a kind of bearish momentum scenario because H4, H1, and M15 were bearish, right? So I know that's the point where it create the impulse to the downside. I know we're leaving equal lows right here. And I'm looking in the session. I see we have, let's say, a point of interest right here. Okay, we have a point of interest right there. Okay, but when the price came right there, if you see, we just creating equal highs, and we have some sort of imbalance up here. That again, let me zoom in a little bit there so you guys can see. Look, the importance of understanding the IFC candle. If you see, okay, this point here didn't have the imbalance because that was taken care of by this week. So this one was mitigated by this small wick. Okay, so where's my last point of interest? Is gonna be that level that closes the imbalance right there. Okay, so when that happens, I see that just below it we are creating equal highs right there. Okay, so this is gonna be another example that I just show you guys. That is gonna be when we reach a point of interest, we wait for what? We wait for the FU candle to happen. This is the 1 minute time frame again. You guys can see right here, 1 minute. Okay, so we wait for the FU candle, and when that happens, we create more liquidity here. Liquidity is taken to the upside right there. This was a 1 to 45 trade. We had really nice targets, not only here, but also in H4. We had a big double bottom to take out liquidity from. So this was a really good trade. Another thing to point out in terms of psychology, that maybe some people are scared of trading M1. Think about something. If I'm not telling you, let's go to whatever example that is kind of clear. Okay, this one, for example. Okay, it's a little bit blurry. Okay, no, doesn't matter. Let's say I don't tell you this is the 1 minute time frame. Okay, so for the people that maybe have been trading IFC or the blocks, whatever it is named, for some time, if I don't tell you this is the 1 minute time frame, would you be taking a buy from there if you know this is a 50 pip stop loss? Okay, most of you 100% will take it. So the natural fractal of the market is, this is the important thing of it to understand, that we know that whatever happens in H4, daily, H1, M15 is what's going to happen in M1. The same way is going to respect the market. So that's why we don't have to have that fear of, and that fear will go out the moment you start to backtest and see that, or to watch our PDFs that we share, that this happens all over again, if you are identifying correctly a point of interest and relevant supply demand zones. Okay, all these trades also you will see a proper breakdown from a higher time frame. I'm just focusing right now on showing you guys the smaller time frame. This Euro JPY, this is a breakdown from the monthly perspective, ended up being a 1 to 100, this trade. Okay, we look how big is our point of interest in this case. This literally was, I think, like 30 pip stop loss, something like this. Okay, but once the market came here, okay, look, first of all, you could tell me, okay, Alex, but the market came here and it gives you like some sort of distribution that you could be selling from. Okay, let's say you sold the market right there. There are two options. Okay, let's say you were risking 1%. You could have taken the L or break even. Okay, let's put the scenario that you just took an L the first moment that the market reacted from our point of interest, this big zone right here. Okay, now you are 1% down. Okay, whatever is the risk that you guys do. Not right now, after that, instead of leaving, you know that point of interest can be still valid. So you watch the market and you see how the market is creating now equal highs. Okay, after that, okay, this is the importance of understanding a structure. Right here, we ended up coming again to a bullish structure in M1. This point here, this point here, equal lows. Now we start to build liquidity to the downside and to the upside. This point here, slightly a little bit a higher high, and this point here actually creates a new higher high. Okay, when that happens, now we are coming to our point of interest again. Let's see how the market reacts. Again, this is M1 time frame. Okay, so now understanding this, let's put this in blue. Okay, now we have this relevant point here, higher low that created higher high. Okay, when the market comes here, look how the market makes a small pause. Okay, like it tried to create a new higher high but fails. When this point fails, okay, that gray candle that tried to create a new higher high is actually buying pressure, but quickly comes down to have selling pressure. So what do I mean by this? This is gonna be a high probable scenario to be selling from. Oops. Take this out. And why is because now we know that we have an IFC candle right there that tried to create a new high, then selling pressure came to the downside. This point right here, put in black. This point right here made the break of a structure. Now we see how this point here was the FU candle that was already taken care of with this week. Okay, so now we are seeing properly how another scenario of equal highs, FU candle, break of a structure. After that, that could be one entry with your stop loss right here. Let's show you guys another entry. Once you have another proper, let's put it in blue to keep it like the same, a proper lower high that creates a new lower low. When we zoom in to see the details, the most important thing is gonna be the refine IFC. The most important time frame I can feel is gonna be even in M1. You're gonna see this happen so many times. The entry where it's gonna be, remember, it's gonna be again in the black one. Why? Because that's our refine IFC. That is the one that actually had the imbalance after it. So we are not taking the gray one. We are taking the black one, the one that properly got eaten by. Again, this point here, did it create a new lower low? Yes. So now we have a new lower high, lower low confirmed. Okay, so once that happens, another entry. Okay, so now we're flowing with the market in M1. Look, multiple 3 entries, super clear. Even though in this one, look again, maybe this was not high probable. I'm gonna show you guys why. Even though we had a lower high that created a new lower low, or maybe equal lows, the problem with this one is I would have seen that this point here is kind of taken care by this week. So I like to see proper imbalance and a proper IFC candle, the same as I was maybe looking at H4. That's the same way I'm trying to look at M1. Okay, at the same time, if this was an H4, H1 time frame, everyone here right now after this mentorship should be selling this. So the same is gonna happen when you guys see the M1 time frame. And this trade, from a monthly, weekly perspective, we're looking to create a new lower low. So ended up being like a 1 to 100 too. But I will do a proper breakdown of this on the last day. Again, clean example of an accumulation in this level right here. So we have a demand zone. This is a cat GPY buy from Wally, I remember. So let me get black. Okay, this is why it's so important. Look, when you have a big point of interest like this level, probably this is like a 30 pip or even 40 pip zone. Okay, look how what's the first time frame that has to give us some sort of indication that the market wants to change the character. So the first time frame is going to be M1. If we don't see that change of character even in M1, the market will continue to flow to the downside. So that's why we don't take unnecessary losses in that sense, and we reduce our losses a lot just by understanding properly the lower time frame. So let's focus on this point. Look, this point creates a new lower low. This point retraces, and this point still we cannot know, even though this has like an imbalance and everything. Okay, even though we have this thing, okay, we can mark it right there just to watch it, but I'm not gonna be trading it, because if you guys see the market, this point here, the high probable thing is to create a new lower low. But the moment we see the market fails to create a new lower low and creates a new higher high, okay, this is M5 time frame, I remember. Okay, we see a break of momentum trend line. That's why this is important too, to see how the market changed the character in such a big movement like this one, that you are trending to the downside, boom, change of character to the upside. If we start to analyze in M5, let's say, what is our last point that we're going to be focusing on for imbalances, IFC candles, whatever. Okay, this is going to be this zone right here. Okay, the reason why he did this is because in M1, he entered based on M1. So this M5 candle had an M1 inside imbalance. So he went for that one and actually played to the T, being, I think it was like a 1.5 pip stop loss, something like that, something crazy. But still, if you guys want to start maybe with M5 time frame, this is still a solid trade with maybe just 4 or 5 pip stop loss in the M5. Again, leaving some sort of equal highs right there, and knowing, of course, that the high probable thing from this demand area is that the price will reject. So the important thing of trading the M1 is by the moment this right here, look how this in a smaller time frame breaks a structure. We come again here, and this point here flows to the upside. Once I see this, if my entry is right here, now I go break even, because now I see there's no reason for the price to come again and tap this zone right here. Okay, so just to know that in terms of when to break even too. Okay, this trade, this is the 1-to-100 trade on GBP USD. Okay, so after the break of a structure in H1 that I will show you, we'll do a proper breakdown on this one, okay? But as Wakar and Wally were walking down the trade in the PowerPoint, if you guys remember GBP USD, we had like some sort of equal lows. Then we had the break of a structure, and we had like a nice FU candle right here. Okay, that FU candle was based in H1, but inside we had a nice IFC candle in M15. Okay, a refined one. So we took that zone because the rest of it was taken care of. So look how the market, literally, when it came to this is our M15 point of interest. Look how properly it respects it. When you start to see the market, this is what Waka was explaining too in the section of Wyckoff, look how the market, you start to see how the market starts to take off all the selling orders, knowing that here we're going to have some sort of reaction. So I'm just waiting for this change of momentum. You can also put the trend line that we speak about, being this one touch, 2 touches, 3 touches, 4 touches. Okay, you see the change of character. And then again, I'm not buying, let's say, right here. I'm just waiting for the market to break my last lower high, lower low. This is why it's so important market structure in the smaller time frame, to have a clear understanding that now you know that the point that led to the break of a structure, it was this one right here. Okay, so we can see how I'm going to mark right now in pink. This point in pink was supposed to create a new lower low, but it failed to create a new lower low. And after that, our green circle, our green point, created a new higher high, breaking our momentum trend line, creating some sort of accumulation in the 1 minute, break of a structure, whatever. And then in the M1, we had some sort of imbalance right here. So let me erase. So this was my entry, my stop loss, again, based on what? On the blue one. Okay, so again, when I see these inputs to the upside, what's the good thing of this? You guys will experience this in a couple of weeks or maybe less when you guys start to understand small time frame. But the good thing of this is when we create this point here, now my entry is there. There's no reason why I cannot go break even, because if I see the market maybe comes right there, that I actually went, I think this was an M5. This was the last point that came to mitigate before running to the upside. And we took another entry right here. Why? Because our point here was already break even. So now it was worth the risk to add a position. So if I'm risking, let's say 1% down here and I'm already break even, every time I scale in, I scale out in percentage. Right here, I will buy with a 0.5%. Okay. Okay, this is just an example how you, okay, I remember this. Let's say you are in a position like this, or this too big. Position like this, you have an IFC candle right here. Okay, So this is another example of how the market, when it comes to our, let's say, supply, point of interest, or IFC zone, okay, the market will start to create this sort of distribution, and then you can trade the test, or again, you can wait and watch. You can actually trade, and this is the way I apply Wyckoff in accumulations and distribution. I like to apply with market structure, because if you see, I maybe don't get the test, but when I see the follow through, that this point here creates a new lower low, I can trade from this level right there. And my risk reward is still super big, because my stop loss, I'm not going to be covering my stop loss being this line of my FC candle. I'm going to be trading it from there. Okay, this is a good example too. If you guys remember the first day, we're speaking in the structure block, or there were two ways that the market will retrace after a new lower low, for example. So this is H1 lower high, H1 lower low. What's the other way the market will retrace? Is creating an for example, a break of a structure or an accumulation. So how do I like to look like this, an accumulation? I see this is some sort of accumulation of orders. I know that, so I'm just waiting for what? Just waiting for this sort of spring that takes out all the lows, and then the break of a structure. That's the way I like to trade it. Okay, so you see these levels here are all taken out. We leave all this imbalance right here to the upside. We take the lows, so I know this is gonna be a high probability scenario that the market will react from. Put there, and I put my stop loss right there. Okay, but first of all, where I'm gonna get out? I'm gonna get out in these levels right here. Okay, and the reason is because I know I'm trading a, let's say, M1, M5 accumulation, but I gotta think that overall this is my bearish push. So the high probability scenario is to get out at these high levels. And look how the market act again. When we reach those levels, the market started distributing. Had a U-tail right there. We had a break of a structure. You guys can see right here. Now market in red. Break of a structure from my last higher low. Sorry, I created my new higher high. If we zoom in, market came here exactly to this IFC candle after the break of a structure. Nice trade too. And then again, from there, market didn't come to reach a new entry right here, which have been that the LPSY, but it's fine. After that, look, really important. How do we identify if we are creating a new lower low or not? This actually happened on the April mentorship. And we took why this is what I was explaining in a blog, and Wally and myself, we were in the back trading. So because the bootcamp used to be like Friday, Saturday, Sunday, and Monday, something like that. So we're trading, Wally and myself, in the back. So look how you can see, and this is the importance of understanding the bodies. So look how the bodies didn't came to create a new lower low. So when I don't see the bodies coming to create a new lower low, okay, I know that something can go on, and this is going to be a run of liquidity, because now I see a wick that takes the low, okay, but later on, what do I see? I see that my break of a structure right here we have a break of a structure from bearish to bullish, okay? So after that, okay, you guys can see, look, the important thing also of the refinement. After that, you go to a smaller time frame. This is M5, I think, but look where exactly the market came. So this was my entry, and this was my stop loss. I think this trade was a 1 to 35. Okay, yeah, it came like right here, up here, but it's not showing the screenshot. But after this, my proper way of thinking is, okay, first of all, this week here, this week there, like the gray one, take care of some imbalance right there. So I knew there was nothing left in a smaller time frame. So that's the reason why I took it from just this level. having my stop loss really tight. Again, if you see the market creates from here, creates a new higher high. And when you see a big candle like this, in this case on M5, you go to M1 and it tapped perfectly the imbalance on M1. And again, another trade that we create a new higher high, complex pullback. If you guys see, we tap the imbalance, goes to the upside. My proper way of thinking is, okay, if we had a run of liquidity right here, and I know this has to be my new lower high that creates my new lower low. If we are failing to create a new lower low at these levels and M5 is already switching, I know that we'll come at least to fill that imbalance. But I'm thinking, okay, if we come that high and we fail to create a new lower low, most likely the market will come and break this level of structure, and this will be a failed lower high that won't create a lower low. So that was my way of thinking, and that in this case actually happened perfectly. Now this is another example of how to properly understand the smaller time frame. This is the 1 minute too. You have a M15 lower high that creates an M15 lower low, and from there the market accumulates in a smaller time frame. And when we come to certain levels, look the precision exactly being this my IFC candle. Okay, and here again you have 2 points of interest. You have the higher one, but you have the lower one right here. Okay, so which one do you have to choose? Here's where you have to see how the market reacts to your point of interest, and when it comes here, you see break of a structure. Now you can be selling from these levels. And again, that's a Utah, but this point here, that our Utah took the liquidity from those equal highs. So, and target these lows. Okay, let's quickly check the chart. Oops. Okay, how is everything going? Is everything going good? Everything clear? Awesome, good, perfect. Okay, what I'm gonna do is, I don't know if I'm running like really quickly, but I actually have like 2 quick examples. I'm not gonna be like quick breakdowns, but just to show you guys really quickly to summarize everything. Just one example is really good in GBP USD buys.
Yo, Alex, just before you continue, let's check with everyone else, because we didn't even have a lunch break today. So I realized we've had a very long day today. So I just want to make sure everyone's good. How long do you need, Alex, to the last part?
No. I need 10 minutes. I'm gonna break down GBP USD,
cool.
To summarize like everything that I've said in a smaller time frame. And I think we good, even though it was kind of quick. Don't worry, like we'll do aftercare sessions. So
cool. All right.
Yeah. Okay. Perfect. Okay, let's go for GBP USD really quick. Okay, this is a trade that I also share the PDF with all the students. I'm gonna start in the H4 time frame. So you guys see we have a lower high that creates a lower low. Okay, so when the market comes to this point of interest, okay, you actually can see, you will see how in a smaller time frame we have equal highs. Okay, inside our point of interest. Let me mark it like this. Okay, so we have a point of interest. If we sell from all the candle, okay, that's gonna be like a 50-60 pip stop loss in GBP USD. But if we wait for the reaction in a smaller time frame, just to show really quickly, we have equal highs, FU candle, test right there of an imbalance in a smaller time frame. We move down, again another point of interest. So now we are trending down. And this was the high probability scenario, right? Because the market was creating lower highs and lower lows. Lower highs and lower lows. We failed, okay? Fails to create a new lower low. And I don't know that until this happens, okay? Then I'm looking for buys from this level. It misses by a pip, okay? So I'm watching the market. This point here creates a new higher high, does not convince myself, comes here, creates new higher high. Again, this point here, small retracement, okay, maybe not as super strong higher low, but at least a point of interest to watch in the future, right? Because that level right there, we guys can see we have imbalance, was not taken care of, so we know it's a point of interest for the future after creating this new impulse. So when we go to a smaller time frame, okay, this right here, the red zone is what I put for IFC red zone. Okay, so we're having a big zone, and I know someone asked about this. So if you guys see how I properly put first point of interest and second point of interest, okay, both of them were based on M1 imbalances, okay, and M1 imbalance was sharing this imbalance between M15. Okay, so we actually had this point and the second one. Instead of putting a buy limit when I have these 2 points of interest, or even put my stop loss down here that would have been like 40, 50 pips stop loss, what I did is I have a point of interest, I set an alarm, and I wait for the reaction. Okay, this M15 time frame. So in M15 time frame, I'm starting to see something. I see equal lows right here, just equal lows, just above my point of interest. I also have equal highs right here. I know we are in this H4 push to the upside. Okay, so we are inside that. So after that, market reacts from my point of interest, the first one, and we have this trending, small trending M15 structure that is broke to the upside. So we have our M15 break of a structure. The most important thing when that happens is how is the market, what is the market price action looking? And you guys can see we had a properly IFC candle, the gray one. Okay, I don't care about the color, I care about the engulf of it. Okay, so now we have this one here. This already, just trading from M15, would have been a solid risk reward. You guys can see this is probably a maybe 1 to 10, 1 to 15, or even more, just based on M15. But after that, okay, we go to M1, and let's see if we can find any sort of entries in this level or even in that level right there during the first reaction. Okay, so now this is M1. Okay, we have our first point of interest right here. Okay, so I don't know if it's gonna react from the first one or the second one. So I have lower high, lower low, lower high, lower low, lower high, lower low. The market comes literally into my point of interest, and when it comes down, again, also look how properly reacts always to our IFC candles, and here also. Okay, after this happens, I'm expecting this to create a new lower low because that's the high probable scenario because M1 is trending down. But look how I put here. Let me get him in. Okay, but look how this fails to create a new lower low. And the reason is because this point here breaks a structure, this structural point being the last one. Okay, this fails to create a new lower low. This one breaks a structure. After that, okay, we know momentum is changing. Okay, we also have a clean break of a structure, of momentum trend line. 1 touch, 2 touch, 3 touches. Here breaks a little bit, but I'm not focusing on the break of the trend line. I'm focusing more of the break of a structure. So once I see this momentum switching from this to this, I'm starting to see some change of character. So after that, okay, this could have been one entry. Okay, the reason why I put it like just 1 pip above is because the stop loss was literally, if I put it right here, was like 0.7 pips or something like that. So you cannot even trade that. Well, I haven't put like 0.7 pips, never. So I was like, okay, just for the reason to get tapped in, I'm gonna put it right here, something like that, and it's gonna be still, I think it was like 2.5 pips stop loss, so it's still worth it. And look at how the market actually creates even equal highs, equal lows, small FU candle. This could have been a banker block, but it missed by a 0, maybe 0.7 pips, small. But then we have the big push to the upside, okay? After that, this push, okay, so we have our first entry right there on our point of interest. This push is the one that led to the M15 break of a structure. Okay, so now we know the market might create a pullback. So you can say, okay, which point of interest I'm focusing on. So I have one right there, I have one right there, and I have one below right there. Okay, if we just do some sort of confluence, we'll see that the lower one being, let me erase this a little bit. The lower one being this one. This lower one is the one that actually makes a confluence with the M15 one, and it's a low one. So I'm happy always to play from the lowest imbalance of the movement. If you see all this is taken care of, no imbalance. So that's the last one, confluence with the M15. Okay, after that, okay, instead, because I'm not liking the setup a lot to play the imbalance from that M1 candle, this can be catching like a knife, like playing from there. What I do is I just wait for the reaction. So I'm gonna play the bunker block. So when this comes here, okay, instead of putting a buy limit, what do? I wait for the reaction. I see some sort of bullishness, and the reason is because look how after the move we leave imbalance right there. Okay, so after that we leave some sort of equal highs. My entry is based on the green line. That could have been a possible entry right here. Stop loss in the red line below. That's like a 2.5 pip stop loss in GBP US dollar, which is amazing. Then again, this point here creates a new higher high. Okay, so now we have a follow through. Now we are having momentum changing again. So if I have H4, H1, and M15 are bullish, and I know that from a structural point, if even M1 is switching to bullish, well, I'm not going to be buying. If everything is going to be in momentum to the upside, right? So when this creates a new push, now I have 2 points of interest. If we can see, we have this one and we have this one. So you can do two things. You split the risk, 0.5 and 0.5, because it's worth taking the loss right here and then get triggered like this, but being your stop loss this level. Instead of this one here, put your stop loss below right here, because then your stop loss is too big, maybe 7, 8, 10 pips, when you can actually, so it's better taking the loss of 0.5, but then this one, when it mitigates and comes to the upside, this is going to play for a 1 to 40 or something like that. So it's worth taking the L in the first scenario. Okay, let's say you didn't like it, you're just looking the market, the price action. This point here creates a new higher high. Okay, and this point here is creating equal highs. Now we have the IFC candle. In this case, it's going to be the black one. And it's the black one because the gray one actually engulfed it. So we left the imbalance right there. Okay, so from there, you can play another one. And look again. Okay, these points here, this point here, after this is a bunker block. If you don't play, it's fine. Don't play, it's fine. Equal highs, no structural points here, just bunker blocks. Look, this level here actually makes a new push. So when this comes to the downside, the last one that has not been taken care of has a small imbalance, reacts perfectly to the upside. Of course, I'm not going to be taking every single entry. I'm just showing you guys market flow in terms of M1, how it flows from the beginning, or from how it reacts from a point of interest moving up. My best one always is going to be, of course, the one that is inside my point of interest. This is going to be my high probable one. In this case, this zone here was also high probable because we came depending on the setup, but my high probable always is going to be the one that plays inside the point of interest, seeing the change of character in a smaller time frame. So also, I think I went for an hour and I tried to do it kind of quickly. So we are not here for 9-10 hours, but let me know in the chat if everything was clear. We'll do extra Zoom calls, don't worry, but at least I hope everyone